Hi, this is Jim McRitchie, Corporate Accountability Forums. We dive into issues and try to come up with solutions. And today we have Jack Moriarty of Ownership America and Corey Rosen of the National Center for Employee Ownership. I have a background that goes back 30, 40 years, I guess at least 40 years in employee ownership. Just on a side note. And so I'm circling back to that to some extent because since then, I've been mostly a shareholder activist. And I've noticed that shareholders have to approve, say, incentive shares. Since 2003, we have to approve the incentive shares awards that companies are going to make. But we never find out where those incentive shares go other than to the CEO, the board, and and the named executive officers, the top five. So I've started filing proposals to try to uncover that, and with the goal of getting more of those incentive shares to go to employees and to get companies to set up employee stock ownership plans and other plans that would give company employees votes. So I'm looking at the largest companies, mostly the S&P 500, but also 3,000 listed companies in the country. Whereas I suspect that you folks are focused more on conversions of private companies to employee ownership. So anyway, I'll just hand it over to you folks, and if you would introduce yourselves, let's start, and then we'll get the discussion going about employee ownership. So let's start with Corey.
Thanks, Jim and Eric. My name is Corey Rosen, and I'm the founder of the National Center for Employee Ownership. And I've been doing this now, been in this field for 44 years. Started off on Capitol Hill, got involved in some of the legislation around employee stock ownership plans, and in 1981 formally launched the National Center for Employee Ownership, which is a nonprofit organization focusing on information and research. We are not a consulting organization, but we are the principal source of information about employee ownership in the US and probably worldwide. And we've done a lot of work on both private and public companies and all the various forms of employee ownership that these companies can take. I'll just give you a personal story, which maybe is a good lead in to this conversation. When we were very young as an organization, and me as an individual, in the early 1980s, we didn't have any money. We were not grant funded. We never have been grant or donor funded. We're funded entirely by memberships and publication sales and conferences and the work that we do. And you can see more about that at nceo.org. That's our website. But after the first 3 years, we'd managed to set aside, largely because the two of us who started it didn't take salaries, about $50,000 to create a reserve. And I decided that to be true to our principles, that we would invest most of that reserve in companies, of course, listed companies, that shared ownership widely with their employees and had a reputation for high involvement management, because this was what the early research, and the subsequent research would confirm this, was showing created the best performance in companies. So we did that. A few years later, we invested in some new IPO companies like Whole Foods and Starbucks
Uh-huh.
and Green Mountain Coffee, and a company you probably never heard of called Physician Sales and Service, which was our favorite because it regularly doubled every year for 4 years. And I kept selling half of it, and then it would double again, and I'd kick myself. But there was, so all these companies really walked the talk at the time. Starbucks still does. And of course, they all performed extraordinarily well. I think 3 or 4 of them were in the top 10 performers year after year. And so the NCO built a nice portfolio out of that. And we broadened that over time to create an index. That index is now housed at a site called Infinite Equity. You can see about it. And that index has outperformed the broader markets every year since its inception now 6 years ago. So it's been a great tool for people who've invested in it. And that personal note, after 30 years of being the director, I decided I wanted to be mostly a full-time volunteer, which I am. And I was able to do that because I'd followed that same investment strategy, and my 401k plan did well enough to let me do it. We'll talk more about why this was not just dart throwing, that there's compelling reason to think that companies who do this are better investments.
Well, thanks so much, Jim. It's great to be with you. My name's Jack Moriarty, and I'm the founder and executive director of a policy organization called Ownership America. And we are a nonprofit policy and grassroots advocacy organization focused on policies that enable broad-based ownership. And my route to the field really started as I was getting ready to go to business school, and I'd been active in campaigns and policy work and spent most of my early career in the healthcare field, but I knew I was really interested in economic policy. And as I was getting ready to go to business school, I heard Senator Kirsten Gillibrand give a talk, and she mentioned employee ownership. And that was the first time, I thought I was relatively well informed and had a good finger on the pulse in terms of policy debates on both sides of the aisle. And that was the first time I'd ever encountered that issue. And that really led me down a path of reading Corey's books and attending the NCEO and Rutgers and all sorts of other gathering areas in the field. And the question in the back of my mind as I got to understand that the track record and the evidence, both of which are compelling enough to say that this is an idea that works. It's an idea that has a significant track record, and it's an idea that is still yet to be fully scaled. And the question I would always ask as I got to know this field was, well, why aren't we talking about this? Why is this issue, despite what we know, despite its history of bipartisanship, why is employee ownership really on the periphery of the national policy debate? Why does it not have a much higher political profile? And my conclusion ultimately was, well, there's never been a true movement for employee ownership like there has been for other issues. And if you look at a whole host of other issues in American history, you can take a look at women's suffrage or marriage equality, and even medical marijuana is probably the best recent example. What these issues have done is they start out in the states and they get an early win. They get a pioneer state behind them, and they use that to build coalitions and move public opinion and really build an infrastructure that can be scaled. And what you see is states adopting these issues is you ultimately see an exponential adoption curve. And so 3 or 4 states becomes 15 or 20 states. And then ultimately you see an inflection point where either Congress or the Supreme Court jumps in, and then it really goes national. And if you think about employee ownership, and Corey will give us a lot of context on the history of this phenomenon in the United States, it's really the exact opposite. The employee stock ownership plan, or the ESOP, we got very top down. It was sort of a chance encounter between Senator Russell Long, who was the Senate Finance Chair at the time, and Louis Kelso, who was a lawyer and an economist that pioneered the issue. And we got it into ERISA, and the rest is history. And I think as much as that was a success, we skipped a lot of that movement building work. And I think it's put a ceiling on our awareness. Employee ownership is not a household issue in the same way that the minimum wage is, and a whole host of other issues that we're familiar with. And so the genesis of Ownership America is to really just solve that problem, to really accelerate the growth of employee ownership through public policy, but really broader than that is to build the kind of consensus and the kind of movement and public opinion that that gets people to ask the question, how do we create more owners? How do we more broadly disperse wealth? And once you ask that question, employee ownership becomes a very compelling answer, as do a number of other asset enhancing possibilities. So I'll stop there, but looking forward to this conversation.
Fantastic. Corey, you're going to lead us from here, I sense. I mean, I am very excited because I think, for me, if you look at the IMF studies that show that, okay, money, if you add 1% to the top 20%, you get a negative 0.035% return. If you add that same amount to the bottom 20%, you get a plus 0.35% return. So, basically what we need to do is push money down to lower income folks. And one of the biggest ways of possibly doing that is through employee ownership. So,
yeah, that's right. And the evidence supports that, as I will indicate. I see that Chris Mackin is joined us on this call. Thanks, Chris. Good to see you. And Chris and I both have permanent pat marks on the top of our head from where people have patted us on the head and said, oh, employee ownership, that's nice, and then gone on to the really important issues. If you're an investor, that's a really not good idea because the evidence is very compelling that companies that share ownership broadly with employees, and there's a variety of ways to do it. Companies that share ownership broadly with their employees perform a lot better than the ones who focus it on the top executives. And, Jim was alluding to a much broader study, not just looking at corporations, but the research on corporations specifically and consistently shows that. By far the biggest research like this was a study that Joe Blasi and Doug Cruz and Richard Freeman at Rutgers and the National Bureau of Economic Research at Harvard put together, where they looked at all of the applicants for the Great Place to Work Award, the best 100 companies to work for. I'd been on the board at the time of the Great Place to Work Institute, and they'd been really reticent about sharing the data, but I persuaded them that would be okay with these folks. And they did this study. Now, if you're an academic or you know about academia, you know that the most critical element is to get a very large number to research, not just a selected sample. So they had 738 applicants with over 300,000 surveys over a 5-year period. That is a database. And they looked at what were the correlates of performance in these companies. And the companies that did two things, and you can't do just one or the other, it's the combination, did two things. They genuinely shared ownership widely with employees, not just with some, but everybody. And secondly, they had these high involvement management strategies. And these are things like work teams and devolution of authority to smaller groups and committees and open book management and the kinds of practices that are aimed at getting more ideas from more people about more things. Starbucks has done a really good job, I think, on combining those two things. Southwest Airlines is another example of a company that has done that for many decades. And those companies consistently and significantly outperform the companies who don't. Prior research showed that companies who focus their compensation, equity compensation on top executives perform worse than companies who share it broadly. And yet investors, who I suspect almost everyone I would talk to would agree, you're right, Corey, that's a good idea. Now let's go on to what really matters. When some years ago, I was at a meeting of impact investors. We went around the room and every one of them said that the problem was that they didn't have an easy way to identify and put their money into funds that focused on this. Well, somebody said to me at a break, you know, you could create a fund like this for free on this platform Motif, which unfortunately no longer exists. So I did that. And then I emailed all those folks in that group and I said, here it is, invest in this. Nothing, nobody invested in it.
I invested in it.
All right, and you did well if you did.
Yeah, but now I can't.
No, you can't.
Well,
you can get the list.
Motif. Okay, I've got to go to Infinite Equity.
It's called Infinite Equity.
Yeah.
But
Okay.
if people want to email me, I can send you the list of companies on the current index. You have to just then invest in them individually, unfortunately, not as a fund anymore. But if anybody out there would like to help form a mutual fund on this, you should let me know. So I want to just briefly talk about two things to sort of set the stage for any further conversation. First, where this idea come from and how big is it? And second, what do we know about its impact, not just on performance, but employees? And so the origin of employee ownership in public companies, we're just going to talk now about public companies because that's what you're focused on. It goes back, as Jack said, to a 1973 meeting between Louis Kelso and Russell Long. And Russell Long just happened to be the most powerful member of the Senate at the time. His daddy was Huey Long. Some of you may know Huey Long. Huey Long was the kingfish, the governor of Louisiana. Every man a king. He ran for president on this very populist platform, and he was assassinated for reasons having to do with his personal life. But in any event, Russell was Huey's son, and he saw what Kelso was proposing to encourage broad-based employee ownership as Huey Long without the Robin Hood. And he became a passionate and effective advocate. When you've got both passion and position, things get done. And when Russell wanted something done in the Senate, it got done. So that started a series of tax incentives for companies who would set up this thing called an employee stock ownership plan, an ESOP, which is a very specific kind of employee ownership plan. And it operates in many ways like a retirement plan and governed by the same laws. And what you need to know is it's a trust the company sets up that is funded not by the employee, but by the company. So the company makes contributions to the trust of cash to buy shares, or it contributes shares directly to the trust. Both of those are common in public companies. The private company use of ESOPs is typically to buy the whole company from a retiring owner. And that's a very highly tax favored way to do that, but it's not really the subject of this conversation. If you're interested in that, you can email me and I can let you give you more information. But the early idea of both Kelso and Long was that public companies would say, well, great, let's set up these plans. And they have the unique ability amongst retirement plans, because of the way that this law got drafted, to borrow money. So the company will have the trust borrow money, use the borrowed money to buy shares in the company to fund growth. And then the company will repay that loan, and you could repay it with pre-tax dollars. So you're able to grow the company with pre-tax rather than after-tax debt. And the employees would get to be owners. And so the expectation was that lots of companies would do this. And the reality was that nobody did. And I mean, nobody did that. So in 1978, so well, we got to give them a push, give them a little nudge. So we'll give them a tax credit. And at first it was a tax credit based on how much money you spent on R&D, because that seemed to be linked to the Kelsonian idea of growth. And then that morphed into, oh, well, that didn't work that well. We'll just give it to them based on a tax credit based on payroll. So you got either 1% or 1.5%, or then it was reduced to 1% of payroll tax credit if you set up these plans. And the expectation was that companies would go beyond that because this would be such a cool thing and everybody would be happy and the company would perform better. And our first research project was to see if that was true. And the answer was no. Companies happily got their tax credit, and that was that. Because after all, the government was buying your stock and never expecting to sell it. That's a pretty good investor. So they took advantage of that. Why not? And there were lots of ESOPs in public companies. In 1984, that was traded for other tax incentives that focused on closely held companies. The next big thing was in the late 80s, Congress said, well, let's try a different approach. Let's give banks an interest income exclusion, a 50% interest income exclusion for loaning to ESOPs. And so companies now could borrow money at cheaper rates. Now, as those of you who are old enough to recall, interest rates in the late 80s were really high.
Right.
So this was resulting in interest rate reductions of 2 or 3% for companies, and full page ads in the New York Times and Wall Street Journal from banks promoting loaning to companies this way. So a lot of companies did that. And they also wanted to get a stockpile of stock to prevent the hostile raiders of the time. ESOPs actually don't work very well for that, but that was the perception. So lots of companies did that, but then that law was also changed in 1992 because, again, the perception that it was only doing what the tax incentive provided and not doing anything more. So ESOPs in public companies started to sort of stagnate. They stagnated even further after the implosions at companies like Enron and concerns about fiduciary risk of investing too much in a single asset. So there's about 600 ESOPs in public companies right now. And some of them are great. Some of them are really done for the right reason. And some not so much. Some are just putting in the minimum amount that you can. And mostly they're being used in combination with 401k plans to fund the 401k. The other development was companies starting to give everybody stock options or similar kinds of awards.
Before you go to stock options, Corey, let me just ask you, backtrack, what is the existing, is there any incentive now for the employee stock?
Yeah, there's two. One is that whatever you put into the plan is tax deductible.
Okay.
You can still borrow through the ESOP and repay the loan through the ESOP and get a tax deduction. And any dividends that are passed through to the participants or that go into the plan and stay there are also tax deductible. So if you're paying dividends anyway, this gives you an extra tax deduction. So there are still incentives to do this.
Okay, thanks.
There are still companies who do it the right way. Then, starting in the late 90s, companies started giving stock options out to everybody. And this became quite popular, and all the comp consultants were saying you should do this. And it continued to grow until the early 2000s. Many people say it stopped growing because the accounting profession said, you've got to actually show the cost of this on your income statement. We had argued pretty vociferously, and it turned out with considerable data that that was just not true. And it wasn't true. It didn't change investor behavior. What did change investor behavior was the rules that Jim talked about, where now you had to approve the equity grants that you were making, and you had to get, as of 2006, as I recall, you'll know better, shares voted in street name didn't count towards getting the absolute majority you needed to do this. So now these same comp consultants were saying, well, now, you know, if we're going to have to go to our shareholders and say, please approve equity grants, we don't want to have too much of them because we don't want our shareholders to be too diluted. And we should stop giving them out to the unwashed masses who aren't going to make any difference anyway. And instead, let's give what we've got to the top executives of the company, the people who, quote unquote, really matter. And so you have a situation today where if you look at the S&P 500, for instance, if you divided the equity awards given to the top 5 to every employee annually, it would be a few to several $1,000s per employee per year. Now, obviously, it's much better to give the equity to a small number of people who can use it to buy small countries with, because that'll be a lot more productive, or at least that is the argument that the comp consultants are making. So what do the data show? As I said, the data show the exact opposite. So not only is it good for investors to push for this, but it's also good for employees, because if you look at these different kinds of plans, where companies have done it, the employees are substantially better off than where they don't. So even in public companies, even with the ESOPs not being nearly as robust as they are in private companies, or the public companies that do give out equity awards to everyone, you're talking about employees ending up with tens of thousands of dollars or more than they would have had if they weren't in these plans. Chobani is about to go public, and employees who were there in the early years, I'm told, will get between $500,000 and $1 million each when they go public. This is not the executives who were there. This is the people who were stirring the yogurt.
Yes.
So these are transformational things. So it makes a big difference to investors. It's in your self-interest. And if you want to know who to invest in, good luck with that. Because you can't go to a filing and see who gets equity in the company. We've put together a list by scanning everybody's websites. And so we know has a plan, doesn't have a plan. We really don't know much about them.
Right. Well, just to
And
interrupt,
that's a
so
pity.
I've asked companies to disclose by EEO1 category that they have to file with the Department of Labor. Disclose by EEO1 category who gets what shares and what voting power is accompanied with that. And of course, I get, I've got legal briefs at the SEC because Facebook and Amazon and other companies do not want to have to release this information, because when the CEO compensation, which is at whatever it is, 300, 400 to 1, then we'll look and see what the equity compensation is, and it'll just be through the roof. So continue.
Yeah, so I'll just conclude by saying we're hearing moans and groans about the Great Resignation. We know that employee ownership increases job tenure.
Right.
And we know that reducing turnover is highly related to performance. So maybe the Great Resignation could be helped if we stop focusing all our equity on the top executives, who tend to turn over pretty regularly anyway, despite our excessive compensation for them.
Well, if you get $99 million in a single year, it's not exactly a retention bonus. It's a license to leave maybe.
Well, Jim, I want to pick up on the point Corey's making here, which is that we don't know very much about the level of employee stock ownership in public companies beyond the named officers. And if you look at what Corey and the NCEO did with this index, it's what's called a thematic index, which is it's a non-representative basket of companies, very high degree of tracking error. So not something that would be able to track something like the S&P 500, for example. And if you look at where the demand is for environmental social governance or ESG type of index products and passive investments, it's in those broad market cap weighted index products. And you can't create one of those unless you have consistent and comparable disclosures from public companies to have a high degree of information integrity. And so I think this dovetails nicely with the recent focus over the last few years on the materiality of human capital management. And for those that have been close to that discussion, it's starting in the academic literature, and it's still a relatively recent idea in the grand scheme of things that employees and investments in employee training and so forth and benefits are not an expense in the income statement, but really investments in future capabilities of the enterprise. And if you look at the research as it's developed over time, really through the 1960s up through now, it's really looked at not only what are the discrete human resource practices that have some relationship to financial performance, but really looking at the bundles of practices, what combination of high performance work systems and high performing workplace organizations are really drive that financial materiality and performance of the company. And that's where the employee ownership research, and Corey touched on this, has really looked at not only that the availability of broad-based employee ownership and equity sharing is itself a driver of performance, but when that's coupled with some degree of open book management, really opening up the value drivers of the company, the financial statements, and allowing companies employees at all level of the organization to really say, okay, this is where I can drive value. And I understand what my day-to-day, how that links directly with the financial performance of the company. That's a very powerful combination. And then, and this is where Christopher Mackin, who's with us today, has a substantial amount of expertise, is developing an ownership culture and really building a culture that understands what that ownership means. And when you have the culture with the information to think and act like an owner, and you've got the ownership stake, that's really that combination is really what generates that performance advantage. And so looking at what's happened over the last 5 years or so, the Human Capital Management Coalition is a group of leading institutional investors. I think, Jim, you'll know the answer on this, around 5.5, maybe 6 trillion assets under management. So a significant voice in the institutional investor community. And they've been pushing the needle on, we believe that human capital management is material. We don't have good information from public companies on this. The SEC needs to do something about that. And we saw the 2020 revised rule on that. And again, this might be a review for those that are knowledgeable about this, but what the SEC did was to say, well, we're going to defer to management and use what's called a principles-based disclosure approach, which is to say each management team will determine which components of human capital management are financially material for their company and disclose accordingly. And while that was a step in the right direction, the gold standard of disclosure, and particularly ESG disclosure, is more prescriptive. And so when you have a principles-based disclosure approach, you don't get the kind of consistent and comparable information that can really systematically inform your investment decisions and create the kind of passive index products and other things that can really...
Right. So one of the things, just interrupting you just quickly, is we need people to write to the SEC because they're considering a rulemaking on human capital management, and we need them to require companies to disclose where shares are going, where equity is going within the company, and publicly disclose that so we can get these metrics. And I don't think that the Human Management Capital Coalition has actually even asked for that. So
Couldn't agree more, Jim. And you're right on. The coalition has really is asking for 4 specific disclosure items: the number of employees, right, who's full-time, part-time, contingent workers, turnover data, the total costs of the workforce, and diversity data, and not only overall in the company, but by seniority, really looking at the bands of the organization to see where the diversity really lies. And my argument, and I would encourage others to write to the SEC, Ownership America is actually launching an employee ownership materiality project to make exactly this case and really synthesize the evidence that we have and make it actionable for investors when that rule is released this year. But to go back to those 4 pillars that the coalition is looking for, I would argue that we have employee ownership has a case to be made that applies to all 4 of them, and particularly on turnover data. And we know with the Great Resignation and just general turnover that employee ownership is a mitigation technique. It's something that can keep employees engaged and keep them excited about the company. And because they have a stake in the outcome of success, that is a reason to stay. And so that's an essential part of thinking about turnover in any kind of company, but also looking at diversity. And I think diversity, equity, and inclusion has focused on a couple of important metrics. It's focused on representation, right? Not just throughout the organization and the leadership team, but also the board, and that's essential. It's also looked at pay. And I would encourage people that are thinking about DEI in a corporate context to add ownership as another component, another material component of that. And so the analogy I like to use, Jim, is that investors should care not only about who has a seat at the table, but also who owns the chairs. And because we don't have that disclosure, we don't know that. And so we have this Dodd-Frank, CEO pay disclosure data that's relatively new in the last decade or so. And we don't have that equivalent information on the wealth side. And we know that wealth inequality and insecurity is much higher than income inequality. And so right now that's an opaque problem, and we won't be able to really mobilize capital and investment into public companies that are high performers on employee stock ownership sharing until we have that information that's consistently disclosed.
So, Eric, can you unmute Steve's mic to ask a question? Steve.
Sorry to have come in late. You might have answered this, but it's just the connection between employee control and employee ownership. And I'd always understood that there was a problem in that there's not direct employee voting. It's that the ownership stake is held in trusts, which are controlled by various ways. Is that true?
Well, it's important to distinguish the different kinds of employee ownership. And so you've got ESOPs, and you've got broad-based equity compensation, and you've got employee stock purchase plans. So if you look at employee stock purchase plans, and there's probably 9 to 11 million participants in these plans, all in public companies. Typically about 30% of the employees who are offered the opportunity to do this buy. And it's really kind of a no-brainer, because the way these plans work, you get to buy the stock at a significant discount, possibly a very large discount, depending on the structure of the plan. You pretty much cannot lose, but people live paycheck to paycheck and they don't do it. But once you purchase the shares, they are your shares. And so you can vote them like anybody else. But most people who purchase those shares sell them fairly quickly. So it doesn't have much long-term impact, but some hold on. The second is equity awards. So these could be restricted stock options, and the like. And same thing, they don't carry voting rights while they are an equity right, but once that right is exercised, you own the shares. Most often, people are going to sell the shares, pay their taxes, and take whatever is left over and do something else with it. And arguably, those people are making the right choice, right? Because if you could do anything with your money, would investing in your own company be the very first most important thing you could do? And that's not likely to be the case for most people. And then there's ESOPs. unlike these other two approaches, ESOPs hold, as you said, hold the shares in trust. And those shares, and it's a lot of employees who are in these. It's probably about 12 million employees in public companies, maybe 11 million, who are in these employee stock ownership trusts. So it's not an insignificant number. And most of these employee stock ownership trusts own between about 2 and 5% of the company. So the rule is that employees in public companies must be able to direct the trustee as to how to vote the shares that have been allocated to them. So there is that requirement. But that doesn't mean that they will. And my guess is they generally don't. And, you know, to be honest, you know, when I used to get proxy statements, I usually didn't even open them because, you know, I got to vote for the auditor and I got to vote for 5 nominees for 5 seats on the board. So it was like the elections in the old Soviet Union.
Right.
So there's not a lot of motivation for people to vote the shares.
Yeah. And now, I mean, one of the things, I subscribe to lots of different things, but one of the things, you know, with Robinhood and else, companies are thinking more and more about their retail shareholders and how do we get to retail shareholders. And so, you know, Peggy Foran long ago at Prudential, which switched from a mutual company to a publicly traded company, she came up with the idea of giving a tote bag to everyone who voted. And, you know, they could do that to some extent because they had lists of people who were shareholders because it used to be a mutual company and now it's a public company. But now through solicitors and whatever, now companies are offering retail shareholders, you know, $1, $2, whatever, something to your favorite charity if you vote, because companies know that basically most retail shareholders have no idea who to vote for, so they just vote down the line with management. So this is kind of a weaponized, you know, way to get to retail shareholders. And the SEC prohibits retail shareholders from voting by a policy. So like a CalPERS or BlackRock or all these companies, they don't look through each proxy generally and vote. They have proxy voting policies. You know, we vote in favor of these types of things. We vote against these types of things. And so they can have a machine do all that. And the SEC has prohibited retail shareholders from doing that because that would be allowing uninformed votes. So it's kind of crazy.
You know, that raises an important point about the institutional shareholders in employee ownership. Another barrier to expanding this has been ISS and Glassdoor.
Glass Lewis, yeah.
Glass Lewis.
Oh, and well, Glassdoor too, maybe.
Glassdoor.
I don't know.
Not Glass
Could
Lewis,
be,
right?
yeah.
Because their recommendations, particularly ISS,
Right.
have never said, well, when you're voting on equity compensation, you should consider who gets it.
Right.
It's simply what percentage.
Dilution. Right. That's all they're worried about.
And that has pushed the percentage down, and it's concentrated it as a result. And I've tried to, over the years, to have conversations with them, and maybe some of you will have more success than I did, but I had none.
Uh-huh.
And you know, again, it's that same kind of thing that, oh yeah, you're right, it's a nice idea, and then move on to something that matters.
Yeah.
Has there been anything done from the investor side, like setting up mutual funds? Or today I was leading a webinar on a social stock exchange that's going to be opening up in Scotland. And it's specifically around theories of change. That is, those groups, the listings on the stock exchange must have a theory of change, and that's how they're being judged. So it's by non-traditional outcomes. Has there been anything like from the investment side that's been done to raise money that will invest in certain quality of employee ownership?
Well, I did mention earlier that I'd created a fund through Motif of an index of 30 companies that both had genuinely broad-based ownership and high involvement management. And the indexes performed extraordinarily well, but Motif didn't, or maybe they did, but they got bought. And so you can't do that. You can't invest in that anymore. Along with the partner of Chris Mackin, who's on this call, and with Chris, we made an effort to try to get a mutual fund or an exchange traded fund to focus on this sort of thing. And we did back testing data to show how this fund would perform. And then we did the Motif thing that showed it performing in real life. And all those data were great. But despite their best efforts, we were not able to raise the kind of money, the $50, $100 million that's needed to launch a fund like this. So no, nobody else has done it. And it does surprise me, because there are other funds. There's Parnassus, the fund that focuses on the best 100, the top 100 companies to work for list, for instance. So
have you shopped it to Calvert and Domini and Parnassus? And
yes.
Yes. Okay.
I wouldn't say we got nowhere.
Yeah.
But we didn't get too far.
All right. Well, I'm thinking of running for the CalPERS board. This will be one of the things that I'll be looking for to get some of their investments into things like this. So,
well, there needs to be a fund for people to invest in to do it.
Yeah.
But as I said, Steve, if you want the companies, you can contact us, because the index you can get from us. The Infinite Equity tracks the performance of the index, but they don't give out the names.
So Jim, I think that we maybe are at some sort of inflection point here or something. I don't want to overly flatter Jack Moriarty, but we've finally got a nonprofit that's focused on being able to coordinate, in a kind of campaign mode, even these kinds of concerns in pension funds and foundation endowments and university endowments and public interest research groups. There's an audience out there that if this information is presented to them in the right way, I think we could probably get something going.
Support Jack.
Take heart.
Yes. Yeah. Thank you, Chris, for that. Yes.
Yeah.
And I think Jack can take all the flattery we can give him.
Yeah.
He's fine. And you should support what he's doing. Go to his website. He's not membership supported. So, this is an organization that which is Jack right now, which has done in the last year more than a lot of other organizations promoting this idea have accomplished in decades. And so it's really an organization people should be supporting.
So it's ownershipamerica.org, and it's a 501c3, so folks potentially can get a tax deduction for this, for contributing and furthering the work of Ownership America. So I want to get that plug in before we...
Appreciate that, Jim. Well, I want to take a quick step back. I know we're probably close to wrapping up, but just to sort of contextualize this, and where does employee ownership and equity compensation fit in the grand scheme of what we'd like to see from all sorts of companies and public companies in particular. To give us some continuity with a previous speaker, Brandon Rees of the AFL-CIO was the I believe, the inaugural speaker in this corporate accountability series, and he talked about the AFL-CIO's position that equity compensation and profit sharing are essential, and importantly, they view them correctly as complements rather than substitutes for a living wage, for sufficient income and wages and benefits and health insurance and so forth. And I think that's spot on. And what I would share is just to be cautious is that unfortunately that mutual exclusivity, or that the substitute dynamic rather than the complement, can go both ways. And I think what Brandon was talking about is, well, we don't want to have a situation where, we don't want to have an Enron where you're conceding your existing retirement plan funds and having non-diversification. And that's certainly something to be avoided at all costs. And but it can also go the other way, which is when Amazon went up to a $15 minimum wage, it was sort of heralded as a big victory for the Fight for 15 movement, which has done enormously important work. And even Senator Bernie Sanders came out and congratulated Amazon. I mean, it got a lot of press, and the flip side of that dynamic, unfortunately, was that wage increase to $15 came at a cost. Amazon announced quietly that it was ending bonuses, and it was phasing out its restricted stock unit program, which had been eligible, both the RSU program and the bonuses for warehouse workers. And so it later rolled out a direct stock purchase program. But I think it's important to realize that we want to be complementary, both with a living wage and strong equity compensation at all levels of the organization. And that was a situation where, and let's be clear, this is not to say that wasn't a net benefit for certain workers. As we know, there is a time dimension to compensation that's enormously important, but it did come at a loss of participation in the wealth creation of Amazon. And so I think we as advocates need to be wary of that and make sure that when we do see equity opportunities, they're not coming at the expense of wages and retirement plan concessions, but also that when we see wins on the wage side, that we're not losing wealth potential benefits as well. And I think that's that Amazon example is an important anecdote to be aware of.
It's an important example. When I talked to Amazon about my proposal there, they said, well, we surveyed our employees. They did not want the equity. They wanted the wage. Well, if you need to feed your kids, house and clothe your family, you need a living wage. And, what the employee stock ownership has to be is something above and beyond for those who are making a living wage. It's not a substitute for a living wage. So, yes, good emphasis.
And on the SEC note, Jim, I'd be remiss if we didn't share some of the disclosure recommendations that we're advocating. And this is largely informed by Corey's depth of expertise. And as I mentioned, at Ownership America, we're going to be doing a more in-depth employee ownership materiality project to really contextualize these disclosure recommendations. But what we'd like investors to ask for that are interested and committed to the idea that human capital is material is four things, and I'll just run through them briefly. The first is the number of shares held in all sorts of ERISA retirement plans, whether that's ESOPs, whether that's 401k and profit sharing plans, and to make sure that that's reported separately, just to get a sense of what is the level of employee stock ownership across those retirement plans. Number two, to ask for the number of restricted stock the restricted stock grants, options, and RSUs issued in the fiscal year, along with the total number outstanding. Third, to report on the percentage of that number that's held by employees other than the named officers. And importantly, to actually report and provide a description on the formula that's used to allocate the awards to employees. And that could include and should include which employees are eligible, the percentage of employees that are actually receiving those awards, and how that award size is determined. And finally, what we'd like to see from the SEC is the total shares purchased in the prior fiscal year under an ESPP, an employee stock purchase plan, and the percentage of eligible employees who bought those shares. And cumulatively, that would provide a level of transparency that is a significant departure from where we stand today and would allow for the kind of investments into high performers on equity compensation.
Jack, we have to get an appointment with SEC commissioners and talk to them. So just to circle back here, one of the things that I had petitioned the SEC a few years ago, that we need to disclose in a machine readable format the votes that funds make. And so, because right now, the only way you can compare how funds vote is if you subscribe to Proxy Insight or some other thing that costs $20,000 a year or whatever. And retail shareholders don't have that. They don't know how their funds in their 401k vote. And so we need this in machine readable format in something closer to real time rather than a year and a half after they vote. The SEC finally came out with a rulemaking in the fall to do that, although it's not going to be necessarily in real time. But I did talk to SEC staff to, try to push that forward. And I would love that if you got on the phone with me and we had a call to an SEC commissioner or two and chatted with them about this and followed up with other information. I think this is information that the human capital management has not been pushing forward. We should also talk to them, like Cambria Allen and others who are who had that effort. So,
absolutely.
All right. Well, if there's anything else, last minute here. Okay. Well, I just want to thank you two for coming on and thank the folks that joined. And I think this has been a tremendous enlightening session for me and hopefully for others who watch the YouTube presentation, listen to the podcast. And next week, we are going to have the former Chief Justice of the Delaware Supreme Court is going to be on our program, and we're going to chat with Leo Strine about what he's been making a lot of waves about employees need to have a voice. So let's see what he says.